Hello, everyone. So this is the first episode of my free trading course. So it's a mid-level trading course. It's meant for people that already understand technical analysis, charting patterns a bit, but it's going to be that added extra layer on top that's going to help you execute trades better and understand better places of when to enter and exit with some real life examples. So I'm very, very excited, and I'm very, very happy and thankful that, we're able to even do this. And once again, I thank you guys for your support always. But one thing that I really, really want to stress before we even talk about this. So I'm happy. Trust me, I'm very, very happy. But what you guys need to understand is that trading is not fun and games. This is not some sort of thing that you have to take lightly. The more serious you take this, the faster your life and everyone around you's life will change. Not many people in your family or your friends group probably know the opportunity that trading allows, right? You've done the math. Everyone has done the math. Oh my God, if I can consistently make this amount of profit per day at this amount of money, I'll be good, blah, blah, blah. Not many people in your life have even been shown this, right? So you understand the opportunity that is here. And I'll tell you, trading is the only thing. Trading will definitely, if you become good at it, will reward you way more than any 9-to-5 job will ever do. And you already understand this. So I'm telling you, you have to take this very, very seriously. The faster you implement and really, really attack this and work hard on this stuff, the faster you can take your family and friends out, first class vacations. You can retire your parents. You can give a much better life to everyone around you. So please take this seriously, and one step at a time. This is definitely going to give you guys a better understanding. And the stuff that I'm going to teach you guys here is you can apply this for the rest of your life to anything with stocks, crypto, Forex, futures, options, anything. So yeah, let's get started. And I hope you guys enjoy this. All right, guys, so let's get it started. First of all, it's very important to talk about market sentiment. So what market sentiment basically means is there are different metrics that judge whether people are bullish or bearish on the market. For example, you could look at the put to call ratio. I'm sure you guys have seen on CNN, the greed index, things of that nature, right? Basically, you need to see what the entire spectrum of all traders feel about a market. And usually, if the majority of people feel a certain way and it's to an extreme, generally the opposite tends to happen. So for example, if the majority of people are extremely, extremely greedy on the market, right? The fear and greed index is very, very greedy, for example. Since it's greedy, the overall market sentiment generally is going to turn the stock market negative, because if the majority of people think the market is going to go up, the opposite tends to happen. All right. So market sentiment basically signifies investors' collective attitude towards the market, reflecting through security activity and prices. Generally, increasing prices indicate bullish sentiment, while decreasing prices denote bearish sentiment. Different sectors respond to different catalysts. So we see on this image here, when federal funds rate or FOMC statement, when Powell gives speeches, when the FOMC releases the minutes of prior meetings, things of that nature, there's a lot of indecision. So this chart that you could see here is from forexfactory.com. So you could get a daily understanding of what macroeconomic news is coming out for the trading day. And it's very, very important to trade based off of this. Generally, if you're holding on to any short-term contracts, you never, ever, any short-term positions, any day trades, anything, you never, ever, ever want to hold through these times. So for example, you can see here at 10 a.m., we have home sales news coming out. Thursday, 10 a.m. during market hours. At 9:59, guys, you should be out of your positions. You should not be holding on to anything during 10 a.m. It's very, very risky. Same concept for 9:45 a.m., right? Anything during market hours, you don't want to be holding on to it. Very, very risky. All right. So market sentiment, very, very important. There's different things that you could look for in market sentiment. You could look at the put to call ratio. You could look at the fear to greed index. And honestly, you could look at my YouTube videos. You could look at any sort of comments in the YouTube or Twitter sections of anything. If people start to become aggressive and rude towards one opposite direction, usually usually the opposite tends to occur. So basically, if people become emotionally charged to the bullish direction, generally it's time to start taking profits on the long side and start leaning short. So there's that for market sentiment. And essentially, there's different stock sectors. Okay, there's 11 different stock sectors, and these sectors are basically broken down into different subsectors. Sectors are broken into subcategories known as industries. So you can see the technology sector has software infrastructure, semiconductors, consumer electronics, software applications, information technology, etc., right? A well-diversified portfolio should not have too many investments in a single sector or a group of related sectors. So if your entire portfolio is tech stocks, you have to realize that if tech stocks end up taking a hit, then your portfolio is going to take a massive hit, right? So that's why you diversify your portfolio, and we're going to talk about different sectors that you can diversify your portfolio with. So now we're going to talk about the 11 different stock sectors. Starting off with the technology sector, XLK. So 26.1% of the S&P 500. The technology sector is comprised of businesses that sell goods and services in electronics, software, computers, artificial intelligence, and other industries related to information technology. Stocks in this sector. We got Apple, Microsoft, Nvidia, AVGO. What moves this sector? In my opinion, the main thing that moves this sector is innovation in technology. So recently we saw how AI really skyrocketed Google, really skyrocketed Microsoft, the chips. It was because AI technology was very new. It's an innovation in technology. Streaming, Netflix created an entire different industry based off of innovation in technology. A quick story. Netflix was built while Blockbuster was still in its heyday, right? Netflix started to mail movies. So while they were still mailing movies, Netflix was building the infrastructure to start streaming sites because they knew right now because they were looking at it on a long-term horizon. Netflix knew that eventually internet would be fast enough to a point where streaming would be possible. But in the early 2000s, our internet was not 4G. It was not 3G. It was not fast enough to stream sites. So Netflix was biding its time. It was trying to have some cash flow on its business, on its books, by mailing the movies. And then once the innovation in technology, once internet caught up, Netflix became Netflix. Crypto is another huge innovation in technology. Coin, all of these mining companies, all of them, it's basically an innovation in technology. And innovation is the leading factor of this sector, in my opinion. Interest rates is another thing that moves this sector. So the higher the interest rate, obviously, the worse it is for these companies. Federal Reserve tapering, so tapering back. So when the Fed was injecting capital and was practicing quantitative easing, meaning they were injecting billions and billions of dollars into the market, they were buying back bonds, everything, right? Once the Fed started to taper back on the bond purchases, on the securities purchases, that caused the market to start to fall. So Federal Reserve tapering. Reducing regulations is also very, very important for this sector, because the more congressional regulations in place for these sectors, obviously the less monopoly that they have, and the worse it is for the companies, the more regulations there are on these companies. And lower consumer debt levels. So lower consumer debt levels is sort of important for every sector. So lower consumer debt purely just means if people have less debt, they have more money to spend on things that they wouldn't normally need, right? So lower consumer debt, you can pay extra money for AirPods. You could buy like an Xbox for your kids, different things. You could upgrade your computers. So lower consumer debt levels is also important for this sector. The next sector, the financial sector, the XLF, 12.9% of the S&P 500. The financial sector is a section of the economy made up of firms and institutions that provide financial services to commercial and retail customers. This sector thrives in a low interest rate environment. Stocks in this sector, JP Morgan, Visa, MasterCard, etc., etc. What moves this sector? High interest rates, CPI numbers, Federal Reserve tapering, reducing regulations, and once again, lower consumer debt levels. Basically, if there's an environment, so if you look, when there's 0% interest rate, that means that the banks are more willing to give out loans because more people are able to take on these loans, and the banks make more money based off of these things. But with higher interest rates, you could just put up a chart of the IWM. The Russell 2000 has been a lagger while interest rates have been increasing, because the majority of the stocks in the Russell 2000, for example, are economically sensitive stocks. So higher interest rates really affect this sector. And lower interest rates, lower consumer debt levels, banks are willing to give more people loans if they have less debt. Next sector, utilities, the XLU, 2.9% of the S&P 500. The utility sector consists of electric, gas, and water companies, as well as integrated providers. In general, the sector generates consistent recurring income by charging consumers and businesses that provide higher than average dividend yields. The sector is often used as an investment during economic downturns. So this is one of the sectors that you can put in your portfolio that is sort of a defensive. It's defensive for your portfolio. It's not super aggressive. These stocks generally have recurring income by charging customers like consistently. So customers will obviously consistently need electric, gas, and water. So that's why, this is more of a defensive company. Stocks in this company, Nextera, Duke, Southern Co., etc. So what moves this sector? Government regulations, deregulation from public or the private sector. 9.9% coming in, the consumer discretionary sector, XLY. So the consumer cyclical sector is an economic sector classification of non-essential consumer goods and services. It consists of retailers, media companies, and consumer service providers, apparel companies, and consumer durables in general. So basically, this sector is things that are not essential. So in general, these companies benefit from an improving economy when consumer spending accelerates. So if people have more money, they're able to pay for the Amazon subscription. They're able to pay more money on Amazon and buy things. Tesla, they can pay for the Tesla new upgrades, etc. Home Depot, they can go and fix their basement or go and fix their garage, etc. They have extra money. So when people have extra money, this stock pretty much does well. So what moves this sector? So stimulus checks. Back when we had stimulus checks, these companies ended up skyrocketing because people ended up getting money that they could spend on these things. Where before the stimulus checks, they didn't have this extra money to spend, right? So consumer price index, the CPI, if things cost more money, then this sector is obviously not going to do that well. Inflation, same concept. Growing economy. So these are different things that move this sector. In a growing economy and in an economy where people have more money, less debt, these companies thrive. Consumer staples sector, XLP. 7.4% of the S&P 500, the consumer staples stocks represent companies that are non-cyclical because they produce or sell goods or services that are always in demand. In general, these companies are defensive plays capable of withstanding an economic downturn. Got Costco, Procter & Gamble, Coca-Cola, and Walmart. What moves this sector? Periods of slow growth and a recession. So these companies are good defensive stocks as well. The energy sector. 4.5% of the S&P 500, the energy sector includes corporations that primarily are in the business of producing or supplying energy, such as fossil fuels or renewables. In general, these companies generate revenue that's tied to the price of crude oil, natural gas, and other commodities. Companies in the energy industry are classified based on how the energy is sourced, such as non-renewables or fossil fuels, and renewables such as solar. Stocks in this sector: Exxon, CVX, OIH. What moves this sector? The price of crude oil. So for example, if you guys look, when news occurs and you have OPEC news, you get news from Saudi Arabia or Russia or Venezuela, OPEC saying they're going to increase the supply, decrease the supply. That moves this sector. The price of crude oil moves this sector. It's very, very important to look at what is going on with crude oil, what's going on with gas, what's going on with all of the different commodities in terms of energy. So it shows commodity prices also moves this sector. So it's important to look at all those different things. The healthcare sector, XLV, 14.5% of the S&P 500. The healthcare sector consists of all businesses involved in the provision and coordination of medical and related goods and services, hospital management firms, medical device manufacturers, and many others. So 14.5% of the S&P 500 is the healthcare sector, unfortunately. So stocks in the sector: BMY, UNH, CVS. What moves this sector? Have you guys ever looked at, biotech or any sort of companies that are on the verge of some sort of FDA approval? I'm sure you guys have seen penny stocks. Oh my God, we're pending FDA approval, we're pending FDA trials, blah, blah, blah. Things like that really, really move this sector. So any stock, because most of these companies in this sector are research-based companies. So, for example, a lot of companies are purely research-based companies. They don't have any working products. And once people just invest in the optimism of these companies providing something that actually works. So FDA approvals and FDA trials really, really move this sector. The industrial sector, XLI, 8.6% of the S&P 500. The industrial sector consists of aerospace, defense, machinery, construction, fabrication, and manufacturing companies. In general, the industry's growth is driven by demand for building construction and manufactured products like agricultural equipment. So stocks in the sector: LMT, HON, CAT. What moves the sector? Demand for building construction, increased employment numbers, and agricultural growth. 8.2% of the S&P 500 is the telecom sector, XTL. The telecommunications sector consists of companies that transmit data as text, voice, audio, or video across the globe. These are phone companies, wireless providers, cable companies, and satellite companies. In general, these companies generate recurring revenue from consumers, but some subsets of the industry are facing rapid change. So these are basically low beta names. So low beta names are safer stocks, essentially. Coca-Cola, you have Verizon, things like this. Stocks like this that don't really move too much, but are on steady growth, are pretty good for your portfolio. But safer. They're safer for your portfolio. So stocks in this sector: T-Mobile, Verizon, etc. What moves this sector? Innovation. So we already have recurring revenue coming from these companies, but to take it to the next level, innovation and technology moves this sector. So for example, 5G. Materials, 2.5%. XLB. The materials sector is made up of companies involved in the discovery, development, and processing of raw materials, from gold and oil to timber. Since these companies are at the beginning of the supply chain, the sector is particularly sensitive to the ups and downs of the economy. Stocks in this sector: Vail, BHP. What moves this sector? The supply chain. If things are moving smoothly, if the economy is working well, if there's movement in the supply chain, then these companies continue to do well. Real estate sector, XLRE. 2.5% of the S&P 500, the real estate industry, encompasses firms in residential, industrial, and retail property investment. Primary revenue sources include rent income, obviously, and real estate value appreciation, making it sensitive to interest rate shifts. So stocks in this sector: OLD, MFA. What moves this sector? Interest rates, and of course, demand for real estate. So interest rates usually drop the price of the real estate value, and demand increases the price of real estate value. Now we're going to talk about sector rotations. So of the S&P 500 and the Nasdaq. So common market wisdom suggests that specific sectors excel or lag during various economic cycles, like we were just talking about. Defensive sectors, like the consumer staples and the utilities, can help investors outperform in a recession, while technology or consumer discretionary sectors can shine in early economic expansions. Types of rotations: value-based, momentum-based, trend-following based. So trend-following based, you have the innovation and technology. Oh, the AI trend. Oh, the crypto trend, etc., etc. Momentum-based. Oh, we see technology companies doing really, really well. Okay, it's time to invest in other technology companies in the same space. Value-based as well. So now we're going to talk a little bit about options. Okay, so this is primarily what we're doing. Obviously, what I'm going to show you guys during this course is applicable to everything. But right now, I just want to talk a little bit in detail about options. Okay, so we primarily trade options here. So calls versus puts. So a call gives us the right, but not the obligation, to buy 100 shares of stocks given by a given expiration time. So calls, basically, if you buy a call, it means that you think the stock is going to go up. If you buy a put, it means you think the stock is going to go down. So calls is basically, if you're buying them, it means long. And if you're buying puts, it means short. Okay. So we buy a call when we speculate that the price of the stock will increase. A put gives us the right, but not the obligation, to sell 100 shares of the given stock by a given expiration date. We buy a put when we speculate that the price of the stock will decrease. So options lingo. A strike price is the set price at which a options contract can be bought or sold when it is exercised. For call options, the strike price is where the security can be bought at the option holder, by the option holder. For put options, the strike price is the price at which the security can be sold. Okay? So in the money is the strike price is less than the actual price. Out the money, the strike price is more than the actual price. At the money is the strike price equals the actual price. So basically, if you want to buy calls far out the, say for example, the strike, this is an example that we could talk about actually. So Tesla trades at 700 and I'm bullish. I want to buy 3 strike prices: in the money, out the money, and at the money. Which strikes can you buy? So we're trading at 700. In the money is the 690 call. So in the money, the strike price is less than the actual price. This applies to calls. Okay. So at the money, you're getting 700 calls because the strike price equals the actual price. And out the money, you're buying something further out. You think that Tesla is going to hit 750 or 720. So instead of paying more money for the at the money or the in the money, you're like, you know what? I think Tesla is going to go fly much more. I don't want to pay the $1,000 a contract for Tesla in the money calls. I want to buy out the money and only pay like 500. So out the money, you could see that the strike price, this is the strike price. It's more than the actual price of Tesla. Okay. So this is important for you guys to understand, but in day-to-day trading, I'm going to be honest, this is not really that important. Like price action, of course, like is way more important, but it's, you have to understand this at first. Okay. So what is intrinsic and time value? So intrinsic value is the current price minus the strike price. So if the current price is $56 and the strike price is $50, then the intrinsic value is 56 minus 50, which is $6. The time value is the options premium minus the intrinsic value. So if the price of the option is at $8, right? The options premium, price of the option is $8, and the intrinsic value that we got, the 56 minus the 50, is $6. Then you subtract those. 8 minus 6, the time value is $2. So the time value increases the price of the option premium. Okay? So it's important to understand, because when you buy calls that expire in the same day, obviously they're cheaper than when you buy calls in 2 years out. It's because there is more time value associated with those contracts. That's what causes that's one of the things that cause the option premium to increase, is the time value. Okay. So intrinsic and time value, with some more examples here. The stock price is $100. You're buying a call for $85 in the money. And the intrinsic value is 15. So, okay. So you're looking at the stock, it's $100. You're buying an $85 in the money call. So the intrinsic value is 15. If you're buying an at the money call, there is 0 intrinsic value. And if you're buying a call out of the money at 110, there's 0 intrinsic value, because this number minus these numbers is either a 0 or it's a negative. But when you subtract the stock price minus the strike price, you get 6. But for this, when you subtract the stock price minus the strike, you get a negative 10. You're not going to have negative 10 intrinsic value. It just boils down to 0. Okay. So for this example, let's look at puts. So the strike price is $100, an $85 out the money put. There's 0 intrinsic value, because puts go the opposite direction. So calls and puts go the opposite direction. Okay. So $100 stock price, put $85 out the money, intrinsic value is 0. At the money, intrinsic value is 0. In the money, 110, the intrinsic value is 10. Okay. So so if Tesla trades at 678, what is the intrinsic value of the 650 calls priced at 35.50? To get this number, you simply subtract 678 minus 650, and then you get the intrinsic value. And then the option is priced a bit higher. Whatever the price is a bit higher, then that is the time value. So the time value of an option is extra money people pay because the option could gain value before it expires. If it has many months left, it's worth more because it has time to change. If it expires today, it's worth almost nothing because it won't change much. Okay. So why is intrinsic, extrinsic, and time value important? So it helps investors understand what they're paying for. Intrinsic represents what the option would be worth. The time value represents the possibility of the option increasing, and extrinsic helps you figure out what can affect the option. So now, let's take a look at open interest. So open interest reflects the quantity of active option contracts currently available. Okay, so this is my chart of TD Ameritrade Thinkorswim. Higher open interest indicates more active positions. It essentially represents the total options contracts in existence. So you could put this on your chart, this thinkorswim. Open interest, this chart right here, this column right here, it shows all of the option contracts currently being held in existence. They're currently being held. All right. Options liquidity is very important to traders as it gauges the ease of buying and selling at market prices. Highly liquid options are easy to trade with orders quickly filled. Conversely, low liquidity options can be challenging to trade. So you should always opt for higher liquid options to facilitate smooth positions and entry and exit. Okay. So volume is also very, very important, because what volume basically explains is, you could see here, the open interest on these contracts is 19,655. But the volume for this same contract for the day is, so currently there's 19,600 contracts being held. Cool. But 236,000 contracts were bought and sold. So that means people bought and sold 236,000 times, but they're still holding 19,000 right now. Okay. So volume is also really, really important when you're trading options. You want to look at this and you want to find options that are highly liquid and have a lot of volume. Okay. All right. So I hope this makes sense. This is the chart of the SPY. So the SPY, the Nasdaq, the IWM, Apple, Amazon, these stocks have very, very good open interest and very good volume. So these stocks are generally really, really easy to get in and out of. They're highly liquid. You'll get your fills properly. The spreads are usually very, very tight. So yeah, you can easily get a good fill price on these. So implied volatility is really, really important, guys. So implied volatility shows how much a stock might bounce around during an option's life. It's linked to supply and demand for options and what people think the stock will do. So when people expect more ups and downs or want an option more, the implied volatility goes up, making the options more expensive. So you guys have seen my live streams and everything like that. There's certain days when IV is much higher. So this is basically what it is. And it causes the option price to inflate and increase, makes it more expensive. So when expectations or demand drop, implied volatility falls, making options cheaper. This matters because it affects the cost of time in the options, which can impact your options trade's success. For instance, if implied volatility rises, your options get pricier. But if it goes the other way, you can lose money, even if you're right about the stock. So, all right, so what is implied volatility? Implied volatility is the expected magnitude of a stock's future prices change as implied by the stock's option prices. Okay, so for example, we have Pepsi trading at 102. The 105 call price is it's 37 days away from expiration, and the 100 put is also 37 days from expiration. The implied volatility is 16.4%. For UMP 103.60, the call price is 272. The put price, 192. The implied volatility is 30.94. So IV causes basically this is showing that IV, these stocks are basically the same price. Okay, and this goes to show that IV, it's almost 2 times higher, which causes the price of the options to be more expensive. Okay. So implied volatility and probabilities. So IV represents a 1 standard deviation change in the stock price. In statistics, you guys know I love statistics and Bollinger Bands and standard deviations. So in statistics, 1 standard deviation encompasses about 68% of the occurrences around the average. The current stock price in our case, right? So 1 year, 1 standard deviation range formula is the stock price plus the stock price times implied volatility. So that's how you calculate the 1 year, 1 standard deviation range formula. So let's look at some examples. of the expected range formula applied to various stocks. Okay, so Netflix, the stock price is trading at 97.50. IV is 44%. So the 1 year expected range on this contract, it's between 54.60 and 140.4. You're basically multiplying the stock price by this number and then adding it to the original stock price. So you're getting, you're getting 44% of 97.5, and then you're adding that number to 97.5, and then you get 140.4. And then the same concept, you're doing it on the negative side to get 54.6. GoPro 16.5, you have 84% implied volatility, which is almost 100%. So that's why we get this 30.36 number. And then 84% drawdown on GoPro would end up being 2.64. Okay, and then Coca-Cola barely moves, so that's why the implied volatility is low, and that's why it becomes a good stock that you could hold in your portfolio. Usually is 42.25. Implied volatility, nothing too crazy, right? So once again, calculating implied volatilities for probabilities. So XYZ is trading at the XYZ 180 call for July 24th. The IV is 65.76%. This is how you do it. So you're getting the stock price is 180. So you're multiplying 180 by the IV. And you are adding that number. This ends up being smaller, right? This is basically 65% of 180, and then you're adding 180 to that number, and you get 298.36. And then to get the negative standard deviation, right, you multiply this by 180, and then you subtract 180 from this number to get 61.632. So that means I am 68% confident that the price of XYZ before July 24th, 2023 will be between these two numbers. Because once again, standard deviation is 1 year, and it's one standard deviation away from the price. Okay, so visualizing the expected stock price ranges, one standard deviation, you could see that this is basically just a way to see where things would go, because based off of a 25% implied volatility. So 25% increase from 100 would make it 125, and then a 25% decrease from 100 would bring it to 75. So that's why we have the majority of this curve, 68% of this curve is where the stock price could be. So calculating the expected ranges for any time frame. So some more calculations here. For example, a $250 stock with 15% implied volatility has a 30-day expected range of this number. So basically, this is a way to calculate the expected range for any different time frame. So you have the 30-day time frame, you have the 1 day time frame. This is, you basically get the square root of the day divided by how many days there are in a year, and this is how you get it for any time frame, basically. And yeah. So now we're going to talk a little bit about the Greeks. Okay, just a little bit about the Greeks. So this is very, very important. And the Greeks basically move. They show you how much money you'll make per option. Okay, so the delta of an option is like a score between -1 and 1. It shows how much the option price changes when the underlying asset's price moves by $1. Okay, so for example, a delta of 20 cents, 0.2 means the option price rises $20 when the asset goes up by 1 and falls $20 when the asset drops by 1. So delta isn't fixed. It changes with the market, and it goes up when an option is in the money, and it goes down when the option is out the money. So quick example, okay? Quick example, it's very, very simple. Okay, guys? So a stock XYZ trades at $180. The $180 call costs $8. Delta is 0.5. Okay? So every dollar increase, delta gets added to this premium. It gets added to the option contract. Very, very simple. That's it. So delta is 0.5. This means that if XYZ goes up from 180 to 181, delta is added to this contract. So goes up from $8, you add $50, so you get 8.5. Okay, so if XYZ falls from 180 to 179, you subtract the delta. So the option contract is now worth 8 minus 0.5, which is 750. So basically, if there are, for example, like wheat stocks or different smaller companies, if a company is trading at $11, their delta will be much higher. Usually their delta can be high, and a $1 move, like if the contract is trading at 0.5, right, and the delta is 0.4, that's almost a 100% move based off of a $1 move, right? But over here in this case, the 180 call, 50 is not, 0.5 is not 100% of 80. So this is a much smaller move in the option contract. Okay. Gamma is also really, really important. So the gamma value of an option indicates how much the delta value of that option will increase for every $1 price increase in the underlying security, for every $1 price decrease in the underlying security. Gamma is the rate of change in delta. For example, imagine you have a call with a delta of 0.6. If the price of the underlying security raises by $1, then the price of the call would therefore rise by 60 cents. I'm going to show you guys an example of how it looks. But basically, when the delta, if the gamma is, all right, so look, if the gamma is 0.1 and the delta is 0.6, the gamma gets added to the delta. Okay, very simple. That's all a gamma is. The gamma gets added to the delta. Okay, so let's give an example. XYZ trades at 180. The 180 call costs $8. This is, show some bad numbers, but delta is 0.5. Okay, and gamma is 0.036. So every dollar that increases, let's just say it's whatever. So every dollar XYZ goes up, the delta will increase by this number. Okay, so we have a $1 contract. The delta, it goes up by $1. So now the delta, so we're trading at 181. Okay, it goes up by $1 from 180 to 181. Now the new delta will be this number added. So now the new delta is 0.5381. Does that make sense? So basically every dollar that it increases, the gamma gets added to the delta for every new dollar that we move up. Okay. All right. So just simply, right, not get too complicated here. Okay. This is the option chain of the SPY, right? They're expiring 7 days from now, October 16th. You could see delta and you could see gamma. Okay. For every dollar that the SPY increases, the delta, you will receive an extra $50 on the contract. And the gamma, once it increases from 432 to 433, every dollar that it increases, now the new gamma, the new delta, you could see the gamma here, 0.5. Then, right, after a dollar move, the new delta will be 0.56. Okay, does that make sense? So you just keep on adding gamma to this delta and you get a new delta value. That's why in the money contracts, the delta is much, much higher because the gamma keeps getting added to it and there's more, intrinsic value, less IV, etc., etc. So basically, you could see that delta is much higher on these contracts than the ones that are out the money. So I hope this gives a bit more understanding. That's another reason why the contract's more expensive, because a $1 move here would equate to almost like a 10 or 12% move on these contracts, whereas a $1 move here would be a much bigger percentage change in the contracts. Okay, so I hope that makes sense. All right, so theta. Theta is also a very important Greek. It's one of the most important Greeks. Okay, so we have delta, gamma, and theta. Those are really the most important ones. So the extrinsic value of an option contract will diminish over time. This is very important because theta takes value away from the contracts. So the extrinsic value of an option contract will diminish over time as the expiration date of that option contract approaches because of time decay. And theta is basically an estimated measurement of the rate at which this happens. So the theta value of an option essentially shows the dollar amount at which the price of the option will fall each day. So assuming all these factors remain equal, an option with a theta value of minus 10, for example, would point 1, for example, would lose $10 from its previous price each day due to time decay. Okay, so very, very simple. Stock XYZ trades at 180. The $180 call costs $8. Cool. Theta is 0.52. You bet 0.51. Okay, so every day, if the stock price does not move at all, if it remains the same, XYZ price stays the same, the option contract will lose $51 a day. So tomorrow, if XYZ doesn't move, my contract will now be worth $8 minus 51, which is 7.49. Okay. So why do the Greeks matter? The primary use of the delta is to give you an idea of how much money you will make if the underlying stock moves as you expect it to, or how much you will lose if the underlying stock moves in the opposite direction. This can help you determine which options give you the best value for money in terms of taking advantage of what you expect to happen. Ideally, if you are speculating on small movements, you want to be trading with options that have low theta value so that the effect of time decay doesn't wipe out any profits that you make from these small movements. Okay, so therefore, an understanding of this value and what it means is very important. Generally speaking, high gamma means high theta. A high gamma means that you can make potentially higher exponential profits if the underlying security moves significantly in the right direction. Once you have a clear idea of how the price of the option is affected by implied volatility and the changes in implied volatility, you will be much better positioned to gauge the risks involved in any possible trades you identify, and may even find opportunities based on the volatility of the option underlying securities. So this is basically like a nice little, just a quick little understanding of the different Greeks. I hope you guys enjoyed this so far. The next videos are going to be way more fun. We're going to be looking at the charts. We're going to be setting up the charts, and we're going to start looking at different indicators and things of that nature. All right, cool. So stay tuned. See you guys in the next video. Hello everyone, welcome to session number 2. Today's video will be a lot more fun because we're going to be going over some charts. All right, but to start off, this is the foundations of technical analysis. What is technical analysis? All right, guys, so we have to go over all of this stuff because we need to get a good foundation and then build on top of that foundation. Okay, it's not just simply like, okay, I'm gonna, look at a chart, I'm gonna start making some money, blah blah blah. Like, there needs to be steps taken, right? Even the most seasoned basketball players or anyone, they shoot their free throws. They stick to the basics and they build on top of it. So that's why it's important to go over this stuff. Okay, so what is technical analysis? Technical analysis is a tool or method used to predict the probable future price movement of a security, such as a stock or currency pair, based on market data. So this is based, also a lot of it is based off of historical data as well. So the theory behind the validity of technical analysis is the notion that the collective actions, buying and selling of all the participants in the market accurately reflects all the relevant information pertaining to a security, and therefore continually assigns a fair market value to the security. So basically it's saying, okay, whatever is going on the chart, people have enough data where the price that's being traded at right now is the price that it should be trading at. Okay, technical analysis allows us to believe that current or past price action in the market is the most reliable indicator of future price action. Historical data. Technical analysis is not only used by technical traders, many fundamental traders also use fundamental analysis to determine whether this should say technical analysis, but many fundamental traders also use technical analysis to determine whether to buy into a market. But having made that decision, then use technical analysis to pinpoint good low risk buy entry levels. So technical analysis is very, very important, whether you are a fundamental trader or purely a technical trader. You need to be using both. You can't, you need to equip yourself with all of the necessary tools. To only trade, you're impossible. You can never, ever be able to trade day to day or make money consistently. If you want to day trade, you want to make money every day. If you want to make money every week, good luck doing that while only being a fundamental trader. Oh, I don't look at charts. Oh, I just look at balance sheets and good luck doing that and trying to make money consistently. You have to use technical analysis. The negative stigma associated with technical analysis is caused by people that don't know what they're talking about. And at the end of the day, if you can be making tens of thousands of dollars with technical analysis, put your ego to the side, learn it, okay? Cool. So technical analysis continued, a type of price analysis which uses mathematical models and calculations to predict future price movement. Supply and demand is driven by many factors, including fear, greed, financial incentive, and herd instincts. These factors create repeatable patterns, which we can recognize and profit from. Technical analysis encompasses a wide range of charting techniques used to try and predict the move of a certain market. Technical analysis includes the use of time, trend lines, candlestick formations, moving averages, chart patterns, and other indicators. Time frames. So the time frame a trader selects to study is typically determined by that individual trader's personal trading style. Intraday traders who open and close trading positions within a single trading day, favor analyzing price movement on shorter time frames, such as the 1 minute or the 5 minute charts. Long-term traders who hold market positions overnight and for long periods of time are more inclined to analyze market using the daily or the weekly charts. Price movement that occurs within a 1 to 15 minute time span may be very significant for an intraday trader who is looking for an opportunity to realize a profit from price fluctuations quickly, during one trading day. However, that same price movement viewed on a daily or weekly chart may not be significant at all. So all of this, it depends on what you're trying to do, on what time frame that you're trying to trade. So the scalping time frames, obviously, 1 minute, 3 minute time frames are the best time frames for scalping, quick scalps. Day trading time frames are the 1 minute, 5 minute, 15 minute, 30 minute, and the hourly. Anything that is within an hour is day trading time frames. And swing trading time frames, 30 minute, 1 hour, 4 hour daily, weekly, monthly. But I'm going to give a bit more detail on this, but what you need to know is the direction that you scalp and the direction that you day trade. It first needs to start with your analysis of the larger time frames. So if on the 4 hour, the daily, and the weekly time frames, right? If we are bearish, then the day trading, you're biased on day trading and scalping should also be a bit leaning bearish. Does that make sense? Because you have to adhere to the larger momentum. Imagine a large wave hitting a coast, and while that wave is coming onto that coast, someone splashes a little water towards that big wave. That doesn't mean anything to the large wave that's incoming. That's just a little splash. So if you're scalping, right, you could be trading alongside those little splashes, but the overall overarching momentum is that wave that's coming, and that is viewed by the larger time frames. So trends, like I was basically just saying, trends help you, give you a clear definition in your mind so you can easily interpret when a trend is coming. So an uptrend can be described as a sequence of higher lows in conjunction with higher highs. A downtrend can be described as a sequence of lower highs in conjunction with lower lows. So the easiest way to identify a trend is if you can draw a trend line. With an uptrend, the easiest way to trade is if you wait for the trend line to be hit and the price bar to bounce upwards off of it, continuing the trend. Moving averages. Moving averages are used as a trend following indicator and a counter trend trading indicator. Moving averages represent the average of the last number of period closing prices. With each new closing price, a moving average drops the last closing price in its series and adds a newest one. So a moving average are usually plotted on the price itself. There are two types of moving averages. Number one, the moving average weighted, the simple moving average, okay? And number two is the exponential moving average, the EMA. So moving average weighted are the simplest forms of moving averages, as they take the arithmetic average of the last number of periods. This means that each closing price has an equal weight in the calculation of the SMA, which is the simple moving average. So the simple moving average, the moving average weighted, generally also moves slower than the EMA, which is the exponential moving average, because the EMA reacts to price faster. Okay, so the simple moving average moves slower, the EMA moves faster. The EMAs, on the other hand, use the exponential average of the last end period closing prices, which makes them quicker to react to new closing prices than their SMA peers. So also, moving averages are also often used as dynamic support and resistance lines. Traders often use longer term moving averages, such as the 200-day or the 50-day moving averages, to find areas where the price could retrace and continue in the direction of the underlying trend. I cannot stress this enough, guys. You need to have the 10, 50, and 200 simple moving average on your chart no matter what. You need to be looking at those, okay? So moving averages are lagging indicators. How I use moving averages. So moving averages are lagging indicators. The 9 and the 21 EMAs signify short-term trends. The 50 and the 200 SMA signify long-term trends. If the moving averages cross over one another, it could signal that the trend is about to change soon, thereby giving you the chance to get a better entry. So we know, for example, there's something called the death cross. When the the golden cross, for example, when the 50 moving average crosses over the 200. The death cross, when the 50 moving average crosses below the 200. So the golden cross, when a smaller time frame crosses over a larger time frame. For example, the EMA cross, the 9 over the 21, the 50 over the 200. If a smaller time frame is crossing above a larger time frame, that is generally bullish. When a smaller time frame crosses below a larger time frame, that is generally bearish. So, identifying bullish and bearish trends. This is one of the simplest ways to go ahead and do this. Okay. When price is trading below the 50, it's in a short-term downtrend. There's weakness. Okay. When the price is trading below the 200, we are in a long-term downtrend. There's a lot of weakness. When price is trading above the 50, it is a short-term uptrend. And when the price is trading above the 200, it is in a long-term uptrend. Price tends to use the 50 and the 200 simple moving averages as support, as well as resistance. So now, ranges and consolidation. A range is a period of time where the price consolidates and creates a range where it neither can break above or below. The key here is to wait for support until there are enough buyers or sellers to push the resistance price above or below the range. So you could see that, in a range, we consolidate, and the level of resistance is the upper level. I'm sure, right? You guys understand. Once it breaks above, prior resistance becomes support, and the initial level of support becomes that second tier level of support. So one thing that you could do is you could you could measure the move of a range and consolidation and use that as a target to the upside. So the target is measured vertically from the bottom of the lowest trough to the highest peak in the range. It is then projected from the point of breakout from the range. So you measure the range from the highest trough to the from the lowest trough to the highest peak, and if we break below, then we put this arrow to the downside. Say this measures $1. If we break below, then you could expect a $1 move to the downside, and if we break to the upside, you could expect a $1 move to the upside. Okay, so now let's finally go ahead and let's have some fun and look at the chart. Okay, we're gonna put the moving averages. I'm going to go over some other things and we can get started and have some fun. All right. Okay, guys. So I just made a new account on Thinkorswim and we're going to use this for all of the charting and different technical indicators that we're going to be looking at. All right. So very simply, we start off, go over here, click charts. This looks absolutely disgusting. What I want to first do is I want to take out these grids. So I think you go to style, go to settings, and then appearance. In appearance, remove this grid. Hopefully it should be good. Perfect. Okay. Okay. So far so good. I mean, this looks better. Ideally, we're gonna want to remove these red lines as well. But first, I want you guys to really see, like, as the course goes, I'm gonna really start giving you guys a close, in-depth look at how I chart everything. So we have to start off by doing it like this first. Okay, so first thing we're gonna do is we're gonna add moving averages to the chart. Okay, so let's go. We have to click studies, edit studies, and then type in simple moving averages. So for this, we're going to add 3 because we want to put the 10, the 50, and the 200 simple moving averages. Okay, so 1, 2, 3. Come on, there we go. And then over here, we edit them. So we change the length to 10, 50, and 200. Okay, 10, 50, and 200. Okay, perfect. Now we see the moving averages, but we see that they're all the same color. So what you're going to want to do is you're going to want to have specified colors for each one. So what I like to do is I keep the 10 the same color, and then for the 50, I usually make it green, and then for the 200, I make it yellow. So hopefully that should be good. Perfect. All right, now it's starting to look a little bit more charty. Okay, so there's that. We have the 3 simple moving averages. Let's also put the exponential moving averages on the chart as well. Okay, so you search up exponential moving averages, moving average exponential. We're gonna add 2 of them. So we could either have, so there's multiple different variations that you could have. You could have the 8, 13, and 21 exponential moving averages. But for this example, we'll have the 9 and the 21. Okay, so we'll put 2, 9 and 21. So we have to change this to 21, and we have to change this color. So we can choose orange, and for the 21 exponential moving average, we could have purple. Okay, perfect. Now we're talking. Okay, so this is basically what we're looking at for moving averages. But another thing that I really want to do is we have to add some space to the chart as a whole. This is still not you can't maneuver anything. This is just ugly chart. We can't do anything. So what we're gonna first do is we're gonna clean up the chart a bit more. So we're gonna right click, go to style, settings, and I really want to remove the red lines. They look terrible. Okay, so you go to time axis, And I think you are supposed to just remove all of these. Perfect. Okay, so that's the first thing I want to remove. And then for expansion area, we want more room to the side. So what we're going to want to do is we're going to make the expansion area 50 bars to the right. So now we have some room to play around with. Okay. And so, now it's starting to look a little better. Cool. The next thing that we're going to have to do is we need to add basically more space to I want to see a monthly time frame as well. So you can see over here when you click on the D, right, you could see there's different time frames. There's the 1 minute, 5 minute, 15, 30, 1 hour, 4 hour, and weekly, and then a daily chart here. I also want to add a monthly. So to do that, we have to go to customize list, add a time frame, and the time interval, I want to have a 5-year time interval. The aggregation period is 1 month. So there it is, 5 years, 1 month. Boom, perfect. And the other time frame that I want to create is a longer daily chart. So what we're going to do is we're going to make a 5-year daily chart. Okay. So we have some things to look back on. Okay. So 5-year, 1 day. Boom. Okay. So this is a good way of starting out and putting, moving average, getting a good feel of basically everything that's going on in the market. You see that the 200 moving average here, when we're trading. So basically we can use the larger moving averages as good confluence of when things are in a longer term bull trend, longer term bear trend, etc., etc. So we're looking at the 5-year. We're looking at the 5-year. Where is it? 5-year. 5-year 1 day chart. There we go. So you can see that over the course of basically since COVID, right? The moving averages were above the yellow line, which is the 200 simple moving average. The 50 crossing above the 200 moving average as well was a golden cross, which is extremely, extremely bullish as well. And then all throughout this entire period, we were comfortably trading above the 200 simple moving average. And I'm sure if you guys were watching, if you guys were trading during this time, people were doing calculations like, oh my God, we're 15% away from the 200 simple moving average. We have to get a pullback. So people were doing calculations based on how far away we were from the 200 simple moving average. And it goes to show how important it is. So in this entire uptrend as well, you could see how the 50, which is this green line, was acting as a good level of support. So once again, guys, this is basically just to show you that these moving averages act as dynamic levels of support and resistance. So not only on, on a longer term horizon in an uptrend, but also in shorter term time frames as well. So you can see recently, like all throughout this entire move to the upside, the exponential moving averages were moving in unison. The 10 simple moving average was this blue line. We could just make it a bit more simple. Let's only look at the simple moving averages for now. Just hide these real quick. And you can see that the 10 clearly, guys, this is like having moving averages on your chart is very, very important. And all throughout every single uptrend, basically, the 10 acts as a level of support. When the 10 crosses above the 50, it's bullish. When the 10 crosses above the 200, it's bullish. Multiple times in history, whenever the smaller moving average crosses above the larger moving average, that is generally bullish. So just keep that in mind. It means that the momentum is switched to the bulls. Okay, so it's important now to look at these things, we could take a look at just the exponential moving averages now as a bit more fun. Okay, so these are the exponentials, the 9 and the 21. So whenever you see that the 9 is crossing above the 21, it's also bullish. And then once it crosses above, the 9 acts as a level of support. When the 9 crosses below the 21, that's bearish. And then the 9 acts as a level of dynamic resistance. And the 21 also acts as a level of resistance. And then until we break back above the 21 comfortably, that's when things switch back. So these moving averages, guys, very, very important to look at. And honestly, one of literally the main indicators that you really, really need to look at are these moving averages. Hedge funds, banks, they trade based off of the distance away. They have their algorithms. They have things written out that if a stock is crossing above on a moving average, or if a stock is X percentage away from a moving average, they change their trading dynamics and they change their trading plans. So having these moving averages is very, very important, not only to see dynamic levels of support and resistance, but also to be able to see trend lines. So being able to see, okay, this is clearly an uptrend here. Now we just crossed below on a moving average. All right, this is in the downtrend. Oh, we just crossed the 9 exponential moving average just crossed below the 21. Okay, downtrend. Oh, it just crossed above, uptrend, etc., etc. So having these things in confluence, being able to zoom out and look at price action as well as these moving averages, very, very important. Okay, so definitely, guys, this is how we want our charts to start looking, because it'll build on itself basically as we continue with the course. Okay, so now that we have the chart set up, we can go to finviz.com for a screener. And I like finviz.com. You could do a lot on it. You can see insider buys and sells. There's a lot. So we can simply go to finviz, go to the screener, and click all here. And what I like to do to find, you could use this for anything. You could use this for a lot of different screening, like for fundamental analysis screeners, for technical analysis screeners. You could look at different indicators and where we are according to the indicators. So simply right now, what we could do is we could look at stocks that are below the 50 moving average, below the 200 moving average, that have an average volume of over 2 million and a current volume of over 10 million. And we're not going to upgrade this. So, and then basically we just filter it out by market cap. We click market cap so that we get the highest market cap to the top. And then if you don't want to look at it in this view, you could click on charts, and then you're able to see how the charts look for everything. So simply now let's just go ahead and look at the first on the list. And basically doing this screener is a good way of looking at stocks that have taken a huge hit. Okay, so these stocks are good for potential bottoms, like basically going long at support, or waiting for a pop back up to a level of resistance and reshorting. So these are like basically underperforming, but they have a lot of volume. So let's take a look at Johnson & Johnson first. Okay, so this is a chart, the daily chart of Johnson & Johnson. And what I did was I enabled the moving averages again. So I have the 10, 50, the 200 on again. All right, so clearly this is not really looking too good, right? But when you look at this on a chart, you could clearly see that we are in a downtrend. Things are at major levels of, like as we get to this level here, it fails. We're in a downtrend. And when you zoom in a bit closer here, you can see that the 50 moving average is about to cross below the 200 moving average, which is known as a death cross. So death crosses are generally very, very bearish. And you could also see that we are trading below the 10 simple moving average, below the 9, and below the 21 exponential moving averages. So clearly, this is not too bullish on Johnson & Johnson, but what you could do, in terms of a trading perspective, is you could wait for bounces back to levels of resistance for opportunities to reshort. Or, if you were watching the chart from, back here sorry, if you're looking at back here, you saw that we were getting close to a prior level of support at 153. This would have been not really a safe opportunity to go long, but it would have been a longing opportunity, because we would have already made a big move to the downside to a prior level of support. So you could see that we wicked right off of this level on October 2nd, and then we bounced. So using this screener is pretty good to see stocks that are very, very overextended to the downside and weak in general. So that was Johnson & Johnson. So the second stock that was on the list was Coca-Cola. So let's go ahead and just look at Coca-Cola. And this is way worse looking. Coca-Cola is known to be a stock that is supposed to be safe. Very, very low beta name that barely moves. It's not supposed to have huge swings. And the fact that Coca-Cola is taking a huge hit like this, it's as if, the Ronaldo news all over again. But, we crossed below the 50 on the 200. You could see the green line, which is the 50, is comfortably below the 200. So we crossed below that, and that really gave a pretty good indication of where the momentum was going to be headed. And this happened right along the highs here. So that is actually pretty interesting. Unfortunately, we weren't really looking at Coca-Cola, but this was really, really interesting. As you could see, how the larger moving averages affect the overall momentum and how things really go. So now, but it is using the screener. Once again, it's a good place of finding some sort of bottoms. And once again, when you look at the prior lows here from back in December over here and back in September of last year, of 2021, you could see that these were prior levels of support, and those historical levels of support, we are back to those levels here and we bounced. So this is also a pretty good way of getting stocks that are also a bit overextended to the downside. And we bounced at a level of support once again, but you can see that it's still trading. We still have room to go before we even touch the 21 exponential moving average. So, this is, it's sort of a bit bullish also because the IWM was a bit bullish recently as well. But, so we just closed above the 10 simple moving average. We closed above the 9 exponential moving average. And generally, we need 2 closes above for a continued move up. So we need 2 closes above moving averages for a continued move in that direction. So we need to see if tomorrow Coca-Cola would also close above. So that's going to be interesting to take a look at. All right, so now when we're going back on FinViz, you could do the same thing with the opposite direction. You want to look at stocks that are above the 50, that are bullish. You want to look for stocks above the 50 and above the 200. Let's look at the overview, set it by market cap, okay? And you get names like Microsoft, Google, Facebook, Meta, like the obvious contenders. So yeah, you get winners when you look for these, right? And then you get losers when you look for the stocks below. And what's really, if you really, really want to look for like bottom feeders that are doing really, really poorly, especially when stocks already are at if we're in an economic downturn, right? If you want to look for stocks that have really high risk reward, you could look for stocks that have a certain percentage below these moving averages. I doubt we would get many. Yeah. So, yeah. But at the point of recessions. You could get stocks that are a certain percentage below the 50 and the 200, and then you get like stocks that could potentially bounce. So right now they're not really the best looking stocks. Obviously you get AMC, Nikola, Mullen, right? But you know, using a screener is very, very beneficial. So using FinViz as a screener, really, really beneficial. You could do the same thing with how far away are you from an RSI? Is it if a stock is a certain percentage below these moving averages and it's also oversold on 20 on the RSI with good volume, and then you could add, you know, with good short float and, you know, a high beta, then you get like some stocks that you could basically try to capture at the lows. But you know, we have to be careful because sometimes they have small market caps. But yeah, in general, you know, you can play around with these, and yeah, it's good to use FinViz, and it's good to understand all this stuff in conjunction. So, you know, we're getting a good foundation for how the chart and everything looks. You guys are, you know, understanding different terms and terminology with everything. So in the next video, we're gonna have even more fun than today's. All right, so yeah, cool. See you guys in the next video. Take care. Hello everyone, welcome to session number 3. This is going to really, really help you guys. This is where a lot of the fun begins. This is going to give you guys clarity of the different levels that I use. If you guys watch my live streams or anything like that, you guys know I talk about, okay, well, I'm going long based off of this level is resistance, etc., etc. I'm about to show you guys exactly how I find all that. Okay, so this is a clean chart of the S&P 500, and the time frame, we're looking at the 5-year monthly chart. Okay, and all of this is going to make sense. So we're looking at the monthly chart, and you go here in drawings, and you're going to want to look for the drawing tool called price level. So what we're going to do here, the main point of this is we're going to be looking for prior levels of support and resistance based off of wicks and candle bodies. All right, so you're going to look for as many levels of support and resistance, just eyeing them. Okay, it's not even going to be anything like monumental. This is just, it works so well. I have not seen anyone really talk about this. It works so well, guys, and don't overthink it. Okay, so drawing, boom, everyone has those settings. First, let's just go ahead and look at the high of February prior to COVID. Boom, make a line there. Very simple. So what you're going to want to do now that you have this level, right, you're going to go to edit properties, click left extension on, and then where it says show price on the right, and then you're going to save that as default. So now this gives you the price on the chart as well, so that helps really, really simply, and it extends all the way to the left because prior levels of support act as resistance in the future. Okay, so that was very, very simple, right? Next, we're just going to go down the list and look at every single different level. So very simply, we see another low here on this wick from February of 2021 or 2022. Perfect. Boom. See 411. This 411 level has acted as a major, major level of support and resistance for months and months. You could see that clearly, right? Just purely based off of one little line. All right, so now you're just going to keep on going down the list. You're just going to keep on going down the list. Look for different areas where confluence exists. This is going to make your chart look really, really messy, but it is very, very worth it because it's going to help you day trade. I'm going to show you guys. So as we continue, you know, just continue to look for prior levels of support, resistance that all coincide, and it works beautifully. It's actually really, really scary how well this works, and it's so simple. Really, anyone can do it. You don't need any sort of technical prowess. You don't need to really know anything. This is this is also a really, really big cheat code, and yeah, you just continue doing it. We're just going to continue going down the list. You see levels of support, resistance. You know, it's going to look pretty messy. Oh, it messed up on that. We could go ahead and put it down here. And yeah, you just continue going down the list, continue going and finding pockets of support and resistance. Cool. All right. At highs, lows, based off of candle bodies, candle closes, you can see the chart is already looking really, really messy. It is what it is. I'm going to show you guys why this is so important. You just keep on making these levels. Keep on making these different levels, and you start off on the monthly chart, and boom. Okay, so that should be fine for now. Okay, so now that we did this on the monthly chart on the SPY, now we're going to go to the 3-year, the weekly chart. Okay, so on the weekly chart, this is starting to really look pretty good, right? And what you could also do is you could, for these monthly levels, you can change the color on all of them. Before you even put these levels on the chart, you can change the color to a different color for each different time frame. So for the monthly, you could change it to a different color so that you know that it's more important. For a weekly, you could change it to a different color, daily, etc., as we go down the list. So we just looked at the monthly. When you zoom in on the weekly, you could clearly see that the weekly adheres to these same levels. And it's pretty mind-blowing. But because on the weekly, there's inside candles that we didn't get, there are new opportunities to look for levels of support and resistance. So there's some more here. So we found one there. This entire area is without levels of support and resistance. Clearly, that's not possible, really. So you go back in history, you look at the prior levels of support and resistance, and you see that there's one here. You see that there's one here. You see that there's some here. There. Here. This entire pocket. This $6 zone definitely has a lot of support and resistance. And you can see that on the weekly better than on the monthly. And you just keep on adding and adding and adding. And the point is, we just try to look for as many levels of support and resistance. Don't mind me as I'm talking. I'm just trying to really explain to you guys that this works. All right. So, yep. So you could see that there's a pocket here. There's a level of support there. There's a level of resistance here as well. Boom. Okay, so now the chart is starting to look a little bit more filled. All right, so that was the weekly. Now what we're going to do is we're going to go on the daily chart. So on the daily chart, it looks even more filled. So what you're starting to see is that when there are even more levels of support and resistance colliding close to each other, those are even more important levels of support. Okay? So it's very, very important to understand that. So this entire 410 to 415 area, lots of support, clearly, right? And now that we're looking at it on the daily chart, there are even more levels that we missed, clearly all down here. But, you know, since we're trading above 400 for arguments, well, for learning purposes, we could just focus on the price action above, okay? So clearly, you know, we did a pretty good job looking at most levels, at most highs and lows already here, right? And just zooming in at almost how perfectly things are working just based off of this. Like literally it took 2 minutes, and I was not, it's not anything groundbreaking. Okay. So these highs and lows coincide really, really perfectly, constantly on lower and lower time frames. So, you know, if you want to get even more granular, there's still more levels that can be made here. Right here, you can see a pocket here. You could see a pocket here. And you could definitely see a pocket right there as well. And these levels just work really, really well. And moving forward, let me go ahead and zoom out. 1 second. Sorry. Go ahead and zoom out here, and you'll see. Yep, things seem pretty good at the moment in terms of these levels. Take some time, but this is going to help your day trading. So just keep going down the list. You see that this low, this high coincides pretty perfectly. You get all the gaps as well. Getting the gaps is very, very important on the lower time frames, because the gaps are really, really important. The gaps are on shorter time frames, they act as magnets, so you really need to have the gaps and add those into the chart as well. So as you can see, you just keep on going down the list of as many different levels of support and resistance as you can, and it makes the chart look really, really ugly, but this is going to help your trading tremendously. There we go. There's some more here. There's a gap right here. Okay. Gap right there. Okay. Cool. Okay. So for now, this should be fine for the daily chart. All right. So now you guys are starting to see the benefit of looking at things on larger time frames and how the charts are affected on shorter time frames. Okay. So we just looked at the monthly, the weekly, and the daily. So now we're going to look at the 4-hour chart. So you can see things are starting to come along a bit, right? We got most of the key levels of support and resistance. You can see how things, important levels, were acting as resistance. You can see multiple touches, etc., etc. And just continue to look for as many different pockets that you might have missed. So right here, we missed this area because we're looking at it on a 4-hour chart. This high acted as support for these 4-hour candles here. We missed this as well. This level of resistance right here acted as support for these, and etc. Right? So we just have to continue adding more and more levels and add everything that we might have missed. All right. So obviously when you're doing this on your own, you're going to, take your time. You're going to try to get everything as perfectly aligned and positioned as possible. But, the concept remains the same. You're going to keep on going down the list of as many different time frames as you can. The largest first, and you're just going to continue going down the list. So you can see that we missed these levels here, this gap here, this high, this there, and you just continue going down the list. All right, so this should be fine. Now for the 4-hour, let's take a look at how things are coming along on the 1-hour chart now. So you can see things are starting to make some sense here. When there are multiple trend lines very close to each other, they're very, very important levels of support and resistance. And you can see how perfectly these levels of support are starting to work on shorter time frames based off of what we did on the larger time frames. And you just continue to add more levels that you might have missed as you continue to go down the list of everything that you're doing. So some more. There's a pocket that we missed right here. This support acted as resistance right there. And you just continue going down the list, guys. You find more opportunities to find more levels of support and resistance to give you guys more clarity. To give us more clarity. This is really all it is. We're just trying to find as many different areas of important levels of support and resistance as we possibly can. So there's a level of support as well. And yeah, things are starting to look really, really well. on this 1 hour time frame. Now let's go ahead and take a look at the 15-minute. You know, before that, we could look at the 30-minute. We should be looking at the 30-minute. You know, and once again, just things look really, really well. We might have missed some pockets here and there, right? All right, so I basically just saved you guys some time. I went down the list, 30-minute, you know, added some more levels here. You know, there's still some pockets missing here, here, and, you know, there's, you know, I don't want to waste that much time just explaining this concept. I hope you guys understand it now, right? So there's a 30-minute. I'm going to take a look at the 5-minute, and things are starting to really, really make some sense here, right? And then you do the same thing. You add more levels where you might have missed on the 5-minute, etc., right? Sorry, the 5-minute, etc., right? So, you're starting to see how things are starting to play out. Okay. Then when you look at the 1-minute chart, this is where things get really, really interesting and fun. So you're starting to see when things get overextended. So now just zooming in, right? Like looking at what's going on right now on the SPY. You're starting to see different levels of support and resistance that are acting based off of the past. And when things get really, really overextended at a major level of resistance here, right, based off of what we saw in the past with a bearish candle, that prompted a bearish sell-off. And just things are starting to make a lot more sense, right? Because you get more clarity, you get more context of the chart as well. So you can see how prior levels of support and resistance, etc., work. And then what you're going to want to do here is you're going to want to add multiple charts to your right. So what you're going to want to do is you're going to add different symbols. So this is where you add multiple time frames. You could add the SPY. You could add the Nasdaq here. Sorry, you could add the Nasdaq here. You could add the IWM here. You could add Apple here, or any other large stocks, right? And you're gonna have to do this on every single different ticker that you're watching, all right? Because this is gonna give you confluence. So what I'm gonna show you guys now is one of my setups, like a finished product, and it's gonna give you guys a lot of clarity on why this is so important. All right, so this is what I look at on a day-to-day, and this is one of the biggest things that help me scalp. So you could see the chart of the SPY, another one on the SPY. I put a different time frame sometimes. The Nasdaq, the IWM, and then I interchangeably look at different charts for other stocks as well. But what the whole point of doing that exercise was looking at the monthly, the weekly, the daily, and then smaller time frames, is that you get confluence of different highs and lows on different tickers at the same time. So why this is important is you could see that, you know, when the SPY would be at levels of resistance or it's showing weakness, the Nasdaq would also be at levels of resistance, etc., etc. So it gives you more confluence. So you could see that the SPY was starting to get overextended, showing some weakness. The Nasdaq was already weak. So this would help you go short as well, right? And then once the Nasdaq started to bounce off of these levels of support down here at 1016, you could see that the SPY back here was also at levels of support, right? So then once the Nasdaq started to break above and show a lot of strength, etc., the SPY was doing the same thing. And at the same time, when you're looking at all of these different charts at the same time, you see that, okay, so let's just look at 1045. Let's see what was going on around 1040, 1045 with both the Nasdaq, the IWM, and the SPY. Okay, so let's go ahead and just look at what was going on at the highs of the day so far for today, October 19th. Okay, so you can see, let's just zoom in, make it easier for you guys here, okay? Because this is the sauce. Don't get overwhelmed. This is literally just take some time to get used to, but this is going to help you guys. It doesn't look pretty, but it is what it is. So there's that. And then let's take a look at the IWM. All right. So right here, you can clearly see that as the SPY was getting very overextended. So first of all, I didn't touch these levels in years. I don't think I added any levels in over a year and a half, 2 years maybe. So yeah, it's been a long time since I even updated my chart. So you can still see I did not touch this at all. I did not touch this. And you could see that the Nasdaq hit a high of 354.83. My level was 354.86. What ended up happening with the SPY? We overshot above 421.60. And that was also weak because we started to see weakness out of the Nasdaq over here at 1046, while the SPY was trying to inch above at 1046. We already saw a red candle on the Nasdaq. Okay, so you're starting to see how this confluence helps. The SPY is trying its best to scream upwards, but the Nasdaq is already like, listen, like we're at a level of resistance. This is the time to start selling. It's time to start going short, especially with, you know, the past hour prior, we had a huge skyrocket upwards. So this was clearly not a time to go long. We're at levels of resistance on the SPY and on the Nasdaq. And then, you know, just for safe measure, we can see what's going on the IWM. Same concept. We're painting a really ugly topping formation. Big green candle, big bull trap. This is not a time to go long. And this arrow indicator is really just irrelevant. So don't pay attention to this arrow indicator. It updates later. So no, it updates lagging indicator. But yeah, so my point is this looking at multiple different charts all at the same time helps a lot. And this is something that you absolutely need to add to your arsenal. This is going to give you guys confluence when you're looking at the different stocks and indicators. And this takes a lot of time. But this is fun because it literally helps you generate more money. And gives you guys more clarity. Instead of jumping into the market and you're looking at things, you know, oh my God, like looking at things naked, right? Instead of looking at things naked, this gives you context. This allows you to understand what the market is doing. Yeah, it's very, very important. So you're going to have to do this on all of the major indices. You're going to have to do this on all of the major large tech stocks at the minimum. You're going to have to do this. The monthly, weekly, daily, and then 4 hour, 1 hour, 30-minute, 15-minute, 5-minute, and then 1-minute timeframes. You do that, guys, you're going to have these perfect levels. And yeah, man, it's beautiful. Really, really simple. And it helps a lot, as you can see. So to the T. And yeah, so definitely do this. I really, really hope this makes some sense so far. Now we can go ahead and continue on with the rest of the video. All right, so we went and looked at the levels already, right? This is session 3, consolidation and ranges. So a consolidation or a range is when a stock's price moves sideways, showing indecision. Okay, so first we're gonna need an old trend, basically showing, you know, a clear uptrend or a downtrend. And then a period where we consolidate, showing some indecision, where the stock is moving sideways. And then a breakout point where we move in a new trend. So we can either create a move to the downside or a move to the upside. So let me go ahead and show you guys an example. All right, so very simply, let's go ahead and just show you guys here. We had a trend clearly rising, right? We had a clear uptrend here. Then we had a period of consolidation here. And then we had a massive breakout. So these are very, very beneficial. You look at these things on larger time frames, and if they show a breakout on a larger time frame and things are looking really, really bullish on a larger time frame, right? You have to lean long on shorter time frames when you're also trying to trade day to day. So looking at the larger time frames really, really helps for overall trend. Sorry. All right, so now let's go ahead and look at some different indicators that we can use. So let's do an intro to. All right, so now let's look at some different indicators that we can use and add to the charts. So this is an intro to the TTM squeeze. So the TTM squeeze is a tool that spots when stocks might explode after staying quiet or consolidating, right? So it tells us if the market is about to make a move, and it helps us find times when stocks stay quiet or consolidate, when stocks gain power and become more volatile, when a trend might stop, and when a new trend might begin. Okay, so based off of the dots on the TTM squeeze indicator as well, when the dots are red, it shows that things are squeezing. Okay, so squeezing out the last bit of consolidation or quietness, right? So we can see that things are quiet here, they're consolidating, and things are getting ready for an explosive move. When you flip from red to green, especially at a level of resistance, etc., it means that the market is building up energy in that direction of where we are starting to move, right? And then when we are light blue, right, on the indicator, and we start to flip dark blue at a level of resistance, that shows that this trend might be coming to an end. And then you can see that when we flip from blue to red, that causes the market to also fall, and the momentum ends up falling lower. So let's go ahead and throw this on the Thinkorswim chart. All right, so this is back to trading Thinkorswim, and for the sake of this video, I went and just removed the drawings so that like we could see the trend, we could see the market, the data easier without all the trend lines, right? So what I want you guys to see is this is the chart. This is the TTM squeeze, all right, and this is back in we're looking at the SPY here. Let's just go ahead and look at the 5-year 1-day chart. Let me show you guys where I'm looking. Let's just, all right, so this is where we are. I'm going to zoom in over here so that we can clearly see what happens when we are trending like this up and down on the TTM squeeze in accordance to what's going on with price action. All right, so you can see that we were negative on the TTM squeeze, right? We started to push a bit bullish. We broke above. We started to turn, from yellow to light blue. And then this, when we did that, from right here, yellow to light blue, that's when things started to be a bit more bullish. Obviously, we dipped lower here as well, but this was a good buying opportunity because the momentum was still bullish. So this caused the market to go back up to all-time highs, and the TTM squeeze was already showing that momentum was bullish, even though we sold off a bit. Same concept over here. We were negative on the TTM squeeze all throughout September, and then we flipped light blue, and this, we broke out of the consolidation period and broke out and just started to become very, very bullish here. And then, once we started turning dark blue at these highs, it helped us see that things were starting to be a bit more bearish. And yeah, you could just continue to go down the list here. Over here, when things were negative, right, we flipped into light blue. This helped us realize that the momentum was going to be bullish, and it made sense to be leaning bullish, right? And then, once we started to turn dark blue again at these highs, bearish setup. The whole point of doing all of this stuff, guys, all of these indicators, everything that we're looking at, you have to put it together with candlestick patterns. All of these indicators, all of these trend lines, everything, you have to look at how the candlestick patterns and how the market overall, how the other indices and stocks are all acting at the same time. You need to get as many instances of confluence as possible. So number one, you're seeing the blue TTM squeeze start to turn blue, right? Number two, you're seeing that we're at levels of resistance on the SPY here, right? So we painted a pretty fake out bullish candle. The TTM squeeze started to turn dark blue. Things don't look good. And I guarantee you, if we looked at the chart of the Nasdaq or the IWM, we would also be at levels of resistance here. So, you know, we flipped bullish, light blue, started to show some weakness, dark blue. Cool. And then this worked out really, really well. Once we turned red, all you need to do was just lean short. Just continue to lean short. Even on pops, you could have just continued to short based off of the TTM squeeze. And then we just continued to fall, right? We just continued to fall. Over here was pretty interesting because we flipped bullish again, but this was a bull trap. And then it just led to another move lower, obviously, right? And then we just had a longer period of consolidation all throughout here for months. You know, we bounced from here. The TTM squeeze ended up being red to yellow. Then once we turned blue, you guys understand now, right? Like when you look at this on a larger time frame, you can see that things work out much better, right? And then you can see how things turn out on the hourly time frame or the shorter term time frames as well. It's the same concept. So, you know, like it helps to look at things on larger time frames first to see the overall extent of the shorter time frames in the market. So it works really, really well. And I would really, really recommend you guys just take a look at this and put it to use on your trading, because it is a very, very beneficial indicator that you guys could use, to be honest. It gives a lot of understanding. Once again here, just looking at today, for example, we had a big sell-off. So this was fake, right? Like this is a good example that I could show you guys. So we had a bit of a period of consolidation. Barely any movement. This was less than 50-cent movement this entire time, but it caused the TTM squeeze to scoop up from very oversold conditions to light blue. Yeah, definitely. This is definitely fake, because we did not see the correlated movement in the price action based off of the correlated movement in the TTM squeeze. Like this was a big move in the TTM squeeze. Usually when we see a big move in the TTM squeeze, we should see a big move in the SPY at the same time. We didn't see that. So clearly you could see that it was still weak. All right, then it turned red, right? We flipped bullish, which was interesting, right? But still, we remained below this key level of resistance at 420.83, and then the initial level of resistance here at 421, which was the key break down point where we broke below the prior levels of support here. So we never reclaimed anything. So even this bullish TTM didn't really mean anything. It was fake. And then, you know, once we then flipped red again, after a fake bullish move on the TTM over here, it was much easier to just lean short the entire time here. And then same concept, another fake move, failure to break above prior levels of support, another flush down. And yeah, so this is how you use the TTM on shorter time frames. So the squeeze time frames. So the larger the time frame, the better it is to look for the overall momentum using this indicator. So the larger time frames show a bigger view and more powerful moves after spotting key levels. So the most important thing with all of these indicators that I'm about to show you, the most important thing is you need to have levels of support and resistance, key critical levels of support and resistance on the chart as you're doing this. So you need to have levels of support and resistance, key levels, and the candlestick patterns. You need to see, are we creating a bull flag, a bear flag, triangles, pennants, along with looking for the squeezes. So, okay, are we at a major level of resistance with a bull flag being formed at a level of resistance? Did we make an explosive move to a level of resistance and we're starting to show some sort of bullish move? That's generally a bull trap. Did we show an extremely weak drop to the downside with even more weakness showing at a level of support based off of level of support that we saw from Thinkorswim at a major level of support? Did we make a huge flush down? That is usually a bear trap. You should not be going short at a major flush down level of support. And then you tie that in together with the TTM squeeze. That really, really helps everything. Okay, so for day trading, you're going to want to look at different time frames. You're going to want to look at the 5 minute, the 15, 30 minute, 1 hour, 4 hour, and the daily time frame for day trades. Obviously, you also need to look at the daily time frame for day trades to see where the overall momentum is going to be going. So the TTM squeeze helps to look at where the overall momentum is headed as well. And then for swing trades, I look at the 4 hour, the daily, the weekly, and the monthly. So all of these things combined really, really help. And it's very, very important, in my opinion, for you guys to, try out these different indicators, see what works for you, see, if they show some benefits. But these are so far some, the TTM squeeze is a beneficial indicator. So, in the next video, we're just going to continue talking about some more indicators. All right. I hope you guys enjoy so far. It's going to take some time, drawing out all the levels, but I promise you guys, the beginning of this video where we were talking about all the levels, it is so important to do that work. It's going to give you guys clarity. You're going to be entering the market with cleaned glasses. Like it's as if you had bad vision and you got some 20/20 vision now. It really, really helps. So you have to take some time out. Try to make it as nice and simple and everything as possible, but it's going to take some time. You're going to have to look for all of the different levels on the major indices and the large tech stocks. But I promise you, it is very, very worth it. And hope you guys enjoyed this video. See you guys in the next one. Thank you. Hello, everyone. Welcome back to another video. We are going to be talking about more indicators and strategies in this video. Let's get started. Let's talk about volume. So volume is essential for all momentum indications and plans and setups. It's the best way to measure money movement accurately. Volume helps us see how much the stock is bought and sold, and it helps predict where it's headed. And volume averages show how high stock volume is within a specific time frame. So all of this stuff is very, very beneficial and important to look at. What's even more beneficial to look at in terms of scalping is called the VWAP, which is the volume weighted average price. So the VWAP is a tool traders use to see the average price a security traded for during a day, considering both volume and price. It's crucial because it shows a security's trend and value intraday. VWAP appears as a single line on intraday charts, much like a moving average. And both retail and professional traders use the VWAP to figure out intraday trends for their trading strategies. Why do we use VWAP? So first of all, I love the VWAP. VWAP is on my chart. I heavily recommend the VWAP. So big institutional buyers use the VWAP ratio to buy or sell stocks with less impact on the market. They aim to buy under the VWAP or sell above it to keep the price closer to the average. So that's big institutional investors. But in terms of regular average day-to-day investors, I'm going to show you guys exactly how I use the VWAP with an example after. So traders also use the VWAP to confirm trends and create trading rules. For instance, if the price is above VWAP, they might go for long positions. And if it's below VWAP, they might prefer short positions. Intraday VWAP. So VWAP starts fresh each trading day. Averaging the VWAP over several days might mess up the true reading. And although some institutions buy under VWAP or sell above it, VWAP isn't the only thing to look at. In strong uptrends, prices may keep rising without touching VWAP. Waiting for prices to drop below could make you miss out if prices rise rapidly. So let's go ahead and take a look at VWAP right now. So real quick, this is how you calculate VWAP. So VWAP measures a security's average price considering its volume. It's calculated by dividing the total dollar value traded by the volume. So the VWAP formula is as follows. We already covered this. And this is also important. So VWAP is a powerful indicator as it considers both price and volume. Unlike moving averages, VWAP emphasizes high volume price points. It helps spot important prices, assesses strength, and find good entry and exit points. And since it merges price and volume, many see VWAP as a more accurate average price of the stock. Importantly, VWAP's calculation doesn't directly impact the stock's closing price. So now let's go ahead and put VWAP on our chart and look at some examples. All right, so back to Thinkorswim, and yeah, we're going to take a look at VWAP. So we're going to go to studies, edit studies, and just simply type in VWAP. Double click, click apply. Boom. So you can't really tell, and it's hard to use VWAP on a daily chart. So that's why you use it on smaller time frames. So let's first go ahead and go into the 1 day, 1 minute time frame. And as you can see here, VWAP is really, really beneficial to day trading and everything as well. So let's just take this chart, for example. So as we're trading above VWAP, you can see that it works pretty perfectly. Well, not really perfectly, but it's a really, really good indication. So if the middle line of the if the middle line of the VWAP is if the price is trading above it, then it's easier to be bullish. But then once we start getting far away from this level, the standard deviation, this line above is the positive standard deviation away from the VWAP. Once you get up here, it becomes more difficult to be bullish because you can see it gets overextended. And then you can just see it just acts as support. And then, you know, when we're yesterday was a bit, this day was a bit choppy because it was also FOMC. But as you come into today, well, when there's no FOMC, you can see that, you know, we had a big gap upwards, but on a bullish day, when we trade below VWAP, either it holds as support or breaking below it. Once you reclaim it, it becomes bullish. So this is a really, really good indication. In general, guys, like you can use VWAP to even trade the opening bell. So if we're trading above the VWAP line on a stock, right, on a 1 minute time frame, you're looking to trade and you see that we're trading above VWAP, it is easier to be bullish on the stock at that time. If it's trading below, it's more difficult. So trading VWAP and using VWAP, I highly, highly recommend putting VWAP on your charts. It really, really works. And, you know, perfect example today as well. You can see that when we get close to the upper standard deviation, it becomes more difficult for it to continue up. And we saw when it starts to trade above this line, it becomes overextended and the price falls lower. So VWAP is really, really beneficial, guys. And I would highly, highly recommend you guys throw VWAP on your charts, especially intraday. It really, really helps. All right, so next let's talk about Bollinger Bands, another very, very important indicator that everyone should be using. So Bollinger Bands are a technical analysis tool used to measure volatility in a stock price. It consists of 3 lines. A middle band, which is, so it's either the SMA or the exponential moving average. Okay, so the middle line is generally the 20 exponential moving average. The upper and the lower bands are calculated based on standard deviations away from the middle band. Okay, so the bands expand and contract based on market volatility. Wider bands indicate higher volatility, while narrower or tight bands suggest lower volatility. Traders use Bollinger Bands to identify potential price breakouts, overbought or oversold conditions, and the strength of a trend. Why use Bollinger Bands? Big institutional buyers use the Bollinger Bands. They are a good indication of overextension to the upside or the downside, and it's one of my favorite indicators for longer term trends. It is hands down one of my favorite indicators. I really, really recommend you guys use the Bollinger Band as well. So how to calculate the Bollinger Band? This is, if you guys want more information on how to calculate it, this is basically how. But to make it simple, there are three lines similar to what we just saw in the VWAP, and the Bollinger Bands are simply just standard deviations away from the middle band, which is generally the 20 exponential moving average. Now let's go ahead and take a look at some examples of the Bollinger Band. All right, so we're back to Thinkorswim. Let's go ahead and add the Bollinger Bands. So edit studies. We can erase the VWAP for now and just type in bands. And then you see Bollinger Bands here. Double click and apply. Perfect. So let's take a look at the Bollinger Bands on a yearly chart. And this is what I really, really like to use the Bollinger Bands for. So Bollinger Bands, hands down, one of my favorite indicators to swing trade with. And the reason for that is because it really, 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 really helps to see where things are way too overextended in either the downside or the upside. So, we can throw this on the 5-year. Okay. So multiple times in history, you can see what ends up happening to price when we trade outside of. So the Bollinger Band, you have to think about it as a way where the market will either come back inside from the lower or the upper. So when we are trading outside of the lower level of the Bollinger Band, price wants to come back inside. The way that this is calculated is that we should not be trading beyond the standard deviation for too long, because what eventually is supposed to happen is we're supposed to come back inside and rebound. So that really, really helps understand where the market is going to go. So if we are trading outside of the lower level of the Bollinger Bands, it is a very, very good indication that we will bounce. Okay, time and time again, multiple times in history, you can see that when we trade outside of the lower level of the Bollinger Band, it leads to a bounce. Okay, and this is really, really one of my favorite indicators. It doesn't happen perfectly. It doesn't happen that same day, right? There's some instances where we can continue falling lower, even though we closed outside the Bollinger Bands here. We still made new lows. That's completely fine. But what you need to realize, what is most important out of this is that when we are trading outside of the lower level of the Bollinger Bands, that, in my opinion, is not a time to start going short. That's more so a time to start longing, to start adding to long opportunities and to start being more bullish. So, you have to lean long, because the risk reward, once you get down to a point where a major sell-off has already happened, there isn't that much room to fall lower. Okay, the risk reward for being bearish at that point is not very high. So it's very, very important to understand that when things are very overextended to the downside, you have to lean long. Okay, in my opinion, that is what generally works the best. So let's go ahead and take a look at the opposite example. And there are quite a few opposite examples as well. So this is one example where we're trading outside of the upper level of the Bollinger Band. And you can see multiple times when we're trading outside of the upper Bollinger Bands, what tends to happen to price. Price wants to reclaim and re-enter the Bollinger Bands. So you must, it's really, so once again, just flip what I said. When we're trading outside of the upper level of the Bollinger Band, you should not be going long. You should either be taking profit or looking to add to shorts. Does that make sense? Because we're already overextended to the upside. That's not a time to start going long. We already made a huge move to the upside. We're already extended past the standard deviation to the upside. That becomes a bull trap. You don't want to enter a position late. All right, so we can see again what happened here. We're at the lower level of the Bollinger Band. Imagine people start going short here. Oftentimes, that's what ends up happening. When we see extreme weakness, our gut reaction is, okay, maybe we should start going short as well. But oftentimes, using these indicators, you can see it's truly not a good time to go short. Rather, it is better to go long. So use the Bollinger Bands, especially when we're trading outside of the lower or the upper standard deviations. Use these bands as a good indication for where the market should return. If we're trading outside of the upper bands, it should return back. It should fall lower. And if we're trading outside the lower bands, it should return, it should bounce higher. So one thing that you really need to understand about Bollinger Bands is this works best when there is not an earnings, right? So if a company has earnings and it's trading outside of the upper bands, that does not mean anything, okay? So don't trade the Bollinger Bands based off of an earnings pop or an earnings drop. That's number one, right? And number two, use the Bollinger Bands on large trillion-dollar companies only. That is the safest way to use the Bollinger Bands. So you should be using it on ETFs, right? The SPY, the QQQ, the IWM, the SPX, various different ETFs, right? And indices. And you should also be using it on the large tech stocks. For example, Apple, Nvidia, Google, Microsoft, Amazon, Netflix, and all of these other large companies. You should only be using it on large companies. You can't throw the Bollinger Band on penny stocks because it's really tough. Because the institutional buyers are not going to be there on companies that fall like this or increase like this on like penny stocks or cheaper companies. And so it's just safest to use on these large indices, okay? All right, so you have to use these large indices to dictate which direction the market is going to go. So if you see that the SPY is very overextended to the downside, you can lean long any other stock that is in the same basket of stocks. So if you see the SPY is very extended to the downside, you can look at other stocks and say, okay, the SPY is overextended to the downside. If the Nasdaq is overextended to the downside, if the IWM is at a level of support, okay, I'm going to go long another stock. Use all of these indicators and use these indices as a way to get more clarity of which direction the market is going to go. So the whole point of trading, you have to add tools to your arsenal. The more tools that you add to your arsenal, the more profitable you'll be. But obviously, you have to find what works for you. But all of this stuff has been working for me really well. And yeah, so now let's go ahead and take a look at some extra indicators and extra ways to judge the market that I think will really help. Okay, so extra indicators. So we're going to look at various different tickers on stockcharts.com. And we're also going to look at some different tickers on tradingview.com. All right, so let's get started by looking at the ones on stockcharts.com. All right, so let's go ahead and just start off. So this is stockcharts.com. I'm going to go ahead and just type in SPX. You have to throw in the $, SPX. Okay, perfect. This is what you do to put the BP SPX on your chart. So what you're gonna want to do here is you're gonna want to make it cleaner. You put the RSI below, okay, and then come here and go to price, and you type in BP SPX and make it show above. All right, so there. Now we have the BP SPX on the chart. So to see a larger view of the chart, you can increase the landscape and then make less bars, and you'll be able to see way more data points. So the way that I use the BP SPX is if the BP SPX is below 30, I cannot stress how important this is, guys. This works so well. When the BP SPX, you click inspect, when the BP SPX is below 30, you have to lean long. You cannot be leaning short when the BP SPX is below 30. Like every single time in history, when we're trading below 30, when we're trading below 30, here below 30, here below 30, here below 30. Every single time when we're trading below 30, it leads to a bounce. Now, how long that bounce takes is a different question. But when you're already at a low point in the BP SPX, which is below 30, which is similar to, RSI, oversold conditions, when the BP SPX is below 30, it's oversold. So you have to lean long, okay? In October of 2022, over here, when we're trading this far overextended to the downside, I was not short. I was continuing to average down long. We had a big pop, great. And then over here, we gapped down even lower. I made a emergency video. I saw that the futures were down 3% overnight. I made a video at 11 p.m. or 12 p.m. Back here, telling everyone to go long because we were very overextended, and it was a perfect play. And this was also due in part, you could also see how the BP SPX was overextended to the downside. So this is really, really important. Add this to your arsenal. Definitely monitor whether or not the BP SPX is, above 70 or below 30. And that really, really helps. That would really, really help gauge which direction you should be trading, in my opinion. So definitely use the BP SPX. So now the other two that I want to look at are the NYMO and the NYSI. Okay, so let's just go ahead and type in NYMO here. And what this shows is, give me a second. Let's go ahead and just, just throw that below. We're not paying attention to that now. So actually, let me just remove this. Give me a second. Okay. All right. So the NYMO, this is really, really good to look at because when it's red, it shows that there is, bearishness. And when it's black, when we're at levels, so what you're going to want to do with the NYMO is you're going to want to put the price of the SPX on a chart so that you could see in conjunction to what is going on with the NYMO, what the SPX is doing. So at multiple times when we are showing at levels of support, right, you're gonna compare how far extended the NYMO is compared to prior times where we made bottoms. Okay, so for example, in this August scenario, we're very, very overextended to the downside. The last few times we got here, right, was back in March, was back in September, and was back in over here in September. Okay, so what happened at each of these points when we got to these levels? So we bounced here in September, right? A bit of a bounce after a few days here in the end of September. Back here in March, we bounced as well. And then over here in August, we also bounced. So the NYMO, using it as a level of support and resistance in conjunction to prior times in history, is really, really good. And when it flips black, it means that bullish momentum is starting to pick up. Especially when you can also throw the 8 exponential moving average on this chart as well. So the 8 exponential moving average also helps to see a quicker view of bullishness or bearishness. So this is really, really important. And then of course, when you see the larger moving average cross above, it could also lead to more bullishness. So that's why we have the 8 exponential moving average. When the 8 crosses above the slower moving averages, it helps a bit more. So the NYMO is really, really important to look at. Next, let's take a look at the NYSI. So the NYSI, similar concept. You're going to want to look at what happened back in history when we are trading at different levels. Similar. So similar situation back in May of 2022. We're at a current price close to May. What happened to the market? So back when we were trading over here before, it led to a bounce. Okay. So you could use this to see what ends up happening. Same concept with bearishness. Back here we fell. Over here we were clearly above this level. This also led to a fall. And then over here, similar level. This is the SPX. You could see it led to a fall as well. So the NYMO and the NYSI are very, very important to look at. So I hope you guys understand this. And also take a look at the BP-SPX. All of these things in conjunction really, really, really help. All right, so we just went and looked over the different stockcharts.com indicators. Now let's go ahead and take a look at the tradingview.com indicators, the VIX, the yields, and the dollar. All right, so here is a chart of the VIX, and this is tradingview.com. All you simply have to do is just type in VIX, press enter, and you get this chart. Okay, so you could see that I have the Bollinger Bands on this chart as well. Now, all of these new indicators that I'm about to show you guys on TradingView right now, they all work opposite of what's going on in the market. Okay, so you can use the VIX to really, really see which way the direction of the market should be going. So if the VIX is very bullish, then the overall market is going to be bearish. All right, so over here, when the VIX was very, very overextended to the upside, right, out of the Bollinger Bands. What do we know about the Bollinger Bands? We know that when it's trading outside the upper level of the Bollinger Bands, we should be returning back inside. So if we're outside of the upper and we're supposed to return back inside, which means that the VIX is supposed to be falling, what is supposed to happen with the market? So when the VIX falls, the market ends up rising. So that means that the overall stock market is supposed to be doing well when the VIX falls. So over here, the VIX was overextended to the upside, and when it falls, it's good for the market. When the VIX falls, it's good for the market. Now, it's also easy to look at when the VIX is overextended to the downside as well. So when the VIX is outside of the lower level of the Bollinger Bands, there should be a bounce back inside into the Bollinger Bands. So if the VIX is supposed to rise, okay, if the VIX is supposed to bounce and supposed to rise here, then we know, because it has an inverse relationship, that the stock market should be falling. Okay, so you could use the VIX as a good indication of which way the market is supposed to go. And the same concept applies to the dollar. So to get the dollar, you type in DXY. Very simple. This works the same exact way usually as the VIX. So if the dollar is very strong, then the overall market should be weak and it should be falling. So same concept. You can add the dollar as another checklist of what is going on in the market every day. So if the dollar is overextended to the upside and it needs to fall back inside, right, according to the Bollinger Band, if it's outside of the upper level and it needs to fall back inside, what happens? So we know that if there's an inverse relationship to the market, when the dollar falls, then the stock market should rise. Okay? Very, very simple. That is the same concept as the VIX. And then, last but not least, since yields are going to be very, very important coming into the end of 2023 and 2024, let's take a look at those. So you get the 10-year yield, you type in US 10Y. And it's the same exact concept. It has an inverse relationship to the market. When the yields fall, then that is good for the overall market. It's inverse. So when the yields are overextended to the upside and they end up falling, that is very bullish for the overall market. So you can look at various different yields. Yields work opposite. So you could look at the 20-year yield. You could look at the 30-year yield. You could even look at the shorter term yields. So to look at the shorter term yields, you type in US 0 5-year. So you type in US 0 5Y to get the 5-year yield. You could type in US 0 2-year to get the 2-year yield. You could type in US 0 1-year to get the 1-year yield. So that's how you find the yields. And once again, guys, it's very, very important to look at the yields and to see what's going on in the market. All right, so we just went over all of these, and there are now some honorary mentions. So the honorary mentions, there are some more tickers on tradingview.com that I want to look at, /ZB and TLT. All right, so we're back to TradingView. Go up here, and this is a chart of the bonds. So you're going to look at /ZB. Sorry about that. One second. All right, sorry about that. /ZB is what you type in on Thinkorswim. To get it on TradingView, you type in ZB1 ! And then you get this chart. So this chart shows the bonds. And when we're trading, so the bonds, they generally trade a bit more correlated to the market. So if the bonds are going up, then that's generally good for the overall market. But oftentimes you can use this as a way to get overextension. It doesn't work perfectly day to day, and it hasn't been working perfectly day to day recently. But in the past, when we become, so I use this in conjunction with the Bollinger Bands. So in the past, when we're very, very overextended to the downside, this multiple days where we're opening and closing outside of the lower level of the Bollinger Bands on the bonds, it gives us extra motivation, basically an extra clarity of also being bullish on the SPY and the overall market. So when we're this overextended here on the bonds, you can be leaning long on the overall market. And that usually really, really helps. And the same concept is when we're trading outside of the upper level of the Bollinger Bands on the bonds consistently, then it becomes more worrisome to be bullish on the market. And you should instead look to take some profits or be bearish. So the bonds, they don't work as perfectly, but they work really, really well. They don't work as perfectly day to day, but they work really, really well in the overextensions. And the same concept is TLT. So the TLT is very, very similar. So basically when we're trading, I use this as for overextensions as well. So when we're very, very overextended to the downside on the TLT, you can be bullish on the market. Over here, very, very overextended to the downside, be bullish on the market. And that generally works. And when we are overextended to the upside on the TLT, over here on the upside to the TLT, you should be bearish on the market. And that generally works as well. So the bonds and TLT, they work in conjunction to the market. They have a more correlated relationship to the market. If TLT is bullish, then the overall market should be bullish as well. And if the bonds are bullish, ZB is bullish, then the overall market is also bullish. All right, so we're going to continue on with the honorary mentions. We're going to take a look at the AAII Investor Sentiment Survey and the NAAIM Exposure Index. So the AAII is really, really important to look at. So it basically gives a weekly update of investor sentiment. And what often happens is when we see a large increase in bearishness or a large just overall bearish feel to the market in the short term, especially in day trading or swing trading in the short term, 1 to 2 weeks, it pays to play the opposite direction. So if you see that there's barely any people bullish, the majority of people are bearish, it's easier to lean long because the majority of people are mostly wrong, right? So the AAII is a good indication as to see what you should not be doing. And the next one is the NAAIM exposure. Just the NAAIM, sorry. So when this is also trading below 30, this is very, very similar to how you're supposed to be basically using the BPSPX. So if we're trading, if it's close to prior levels of support of what happened back in history, right? When we are making very big lows on the NAAIM, it helps, and it's usually a time to do the opposite. So over here, we fell dramatically on the last week of October, right? And this was a really, really good time to start leaning long. And you could see that big drop here was a good time to start leaning long. We had a big spike up in July. This was obviously not safe, and it was a good time to start leaning short. So looking at these two investor sentiment surveys and basically a way to see what people are feeling is really, really important. And I really, really recommend you guys look at all of that stuff in conjunction. All right. So now, last but not least, here are basically every indicator that I use personally. So for scalping on the 1 minute time frame, because I only use the 1 minute time frame, I have the 8, 13, and 21 exponential moving averages. I have the 10, 50, 200 simple moving average. I use the Bollinger Band. I use the VWAP. And I use support and resistance levels. For swings and long-term trades, I use everything, all of the above, except VWAP. Okay, so this is my entire setup. This is literally what I use. This course should have given you guys a good base and a good foundation of what works, what doesn't work, and it'll definitely give you guys clarity of how to look at the market in a new way. And I really think that this is gonna help a lot of people. And now, in the future, the only thing now is just adding trading setups. So we already saw some trading setups that you could have used for the Bollinger Bands, et cetera, and in conjunction to what's going on with the BPSPX and VIX and the dollar when it's overextended on the Bollinger Bands. But now, the only thing that's left is to make a list of different trading setups that work. And I'm going to do that over the course of the next, few weeks, few months. I'm going to be recording different trading setups that I take in Wave. And then also I'm going to, make videos on those. So I'm going to make a playlist of videos of different trading setups. So stay tuned for that. But, aside from that, I really, really hope this course helps you guys. And I know for a fact it will. So without further ado, thank you guys for watching. This was a long time coming. There's a lot more that I'm going to be adding to the channel in the future. But this, I am pretty happy with this course. So in the future, I'm going to make a completely beginner's guide. But this is a good course, and I'm pretty sure you guys enjoyed it as well. So I would love to hear your feedback. I would love for you guys to share this with your friends and family. I'm not asking for any money for this course. It's all free, as you can see. And all I can ask is for you guys to just share it widely and, get the news out there. So hope you guys enjoy. And it's always a pleasure to do this, to help. And yeah, genuinely, I really wish the best for all of you guys. And just take it one step at a time. There's a lot more to do. But but just watch this course a few times and I'm sure it's going to help. All right. Have a good one, guys. Love you guys. Take care.